Welcome to what I hope will be a productive Tuesday afternoon discussion on modern banking. By way of introduction, my name is Mathew Chacko. I have about 22 years of experience in advising large corporations on technology matters. And technology seems to be the flavor of the season with the RBI at this particular point. I have with me two of my colleagues from my banking tech team, Soumitra Ponkshe, who's a senior associate, does a lot of work with what is now India's largest private bank, plus a plethora of other banks across the country. And Ruchika, who's got a focus on open banking, neo-banking, and entities that contract with banks. So the two of them will bring two opposite perspectives to play. One will tell you what the bank wants, and the other can tell you how difficult it is to give the bank what it wants. With that, quick introduction to the topic as well. As all of you are no doubt aware, multiple banks have been the subject of a series of audits in the last few months, where the Reserve Bank has asked them all to beef up their digital infrastructure, cybersecurity, and data protection measures. And that's become a very, very large portion of a set of new age worries for banks these days. So we'll try and give you, in an hour, it's impossible to give you answers to what are some of the most toughest questions plaguing banking today. But what we will try and give you is a map of where regulations originate from, and a direction in which the Reserve Bank of India expects you to head to. We will try and avoid specifics. We've had multiple questions over the last 2 weeks on whether we'll cover the use of artificial intelligence in banking and the impact of RBI's directions. We'll tangentially cover it. We'll provide you a far more detailed discussion on artificial intelligence and its use and its risks, maybe in the weeks to come. But at this point, we'll look at data governance, we'll look at IT infrastructure for banks, and we'll particularly look at it from the prism of complying with the RBI's regulations, both the letter of the regulations as well as the spirit of the regulations. Before we start, house rules, please feel free to raise your hands and speak. Otherwise, it'll be a monologue and multiple people will fall asleep. So happy for you to interrupt us at any point in time. Alternatively, if you just want us to shoot us questions in the Q&A slot, that's okay as well. And we'll kind of work those questions into our sessions. With that, Soumitra, do you want to take this forward?
Yes. Will you move on to the next slide? Okay, so like Mathew said, technology has been kind of the flavor of the season. And given the way that tech has been rapidly advancing in the last few years, banks and regulated entities generally have had to kind of adapt to it to ensure that the offerings that they have are offered not just through their physical offices, but also through a tech platform, which can either be through a website, a web app, a mobile application, or anything like that. No one, like they're trying to kind of adapt to a system where the customers don't have to come down physically to the bank's office for anything that they want to transact on. And this is kind of like, it has been a continuous ongoing shift that has been going on over the last few years in the Indian banking ecosystem generally. While essentially tech does provide the operational convenience to customers, it also opens up the REs to kind of all the risks that are tied with kind of bringing in tech with respect to their offerings. Regardless, banks have quickly evolved from their traditional models and kind of adapted easily to the digital banking challenge in order to kind of align with this new paradigm. When we talk about financial sector, usually any discussions with respect to any emerging technology gives us an opportunity to discuss the manner in which the financial ecosystem would need to interact with any newer technology and also combat any underlying risks that are associated with such tech. The RBI also has been cognizant of this emergence of the new digital models, and accordingly, they have also increased their maturity and have come up with regulations and frameworks to kind of oversee the same. Now, the first question would be what exactly would be IT infrastructure? Now, IT infrastructure would include all the tech that the bank has in place. It would say cover their servers, the storage systems, platforms, which would be their backend and their customer facing platforms, other networking security components. It would also include any gadgets, like say a tablet, computer, laptop, or even a mobile phone that any of the bank's employees use. Now, this IT infra is essentially the bedrock of any security measures that the bank has to put in place, the data control that it has to have in place, and also the customer experience. When deployed properly, and we see this with a lot of the apps that we use that the REs have come up with, the IT infra essentially provides a seamless digital experience, not just to any customer that the regulated entity has, but also helps the bank's team that is working at the back end to kind of make sure that everything moves ahead seamlessly. The banks, while they're again using tech to scale their operations a lot, they also have to ensure that they comply with the regulatory requirements that are that go hand in hand with using tech in the financial sector. One problem that we usually see here, we talk about like using vendors that the bank partners with. It's not always operationally possible for the bank to develop everything in-house. And this kind of leads to banks partnering with other, say, tech providers or other fintechs in the ecosystem. These partnerships and collaborations usually involve complex tech integrations and also a lot of data sharing aspects. So these usually ought to be very carefully thought through to mitigate any regulatory non-compliances and losses that may occur through such partnerships. RBI recently released a guidance note on this operational risk management and operational resilience, which gives like an indicative list of third parties, which include external consultants, cloud service providers, payment processing firms, IT operation vendors, all of that. Another buzzword of the season again is data protection. While again, where banks are sharing data with any other party or even in their internal ecosystem, they must ensure that secure data sharing practices are put in place. There must be enough arrangements that are put in place which ensures that the bank's internal infra is in fact compliant with all the regulatory requirements that it has.
Soumitra, if I could just jump
Yeah.
in here. So one of those things that you should ideally think about is if you're on the bank side, when you're tying up with SaaS service providers, essential SaaS service providers, and if you're a SaaS service provider providing service to banks, what kind of IT security, data protection, backup, business continuity processes you have in place? We've negotiated multiple SaaS agreements for banks, let's say 2 years ago, 1.5 years ago, where very large, sophisticated service providers argued that none of these data security protocols should be applicable to them because, hey, SaaS. Now, that's a position that at least finally the market has moved from, because all the banks, so I mean, deals which could ideally have been closed within 1 month took a year because there was an obstinate refusal to engage with banks' IT governance and cybersecurity requirements. The RBI is very clear, depending on how your SaaS provider is positioned, you may legally be required to comply with bank requirements. Even where the RBI regulations may not apply to you, most of our large bank clients would impose their own version of IT security and data protection measures on SaaS and smaller TSPs engaging with banks. So good idea to start, brushing up the rules and making sure that your software and technology infrastructure complies with them.
Yeah. And essentially just taking that like ahead, the DPDPA is not yet like kind of into force, like the rules will come into force eventually, hopefully at some point of time this year, but the banks will need to ensure that they are compliant, not just internally, but even through their arrangement with the third parties that they partner with. These obligations under the DPDPA would have to be flown down. Usually the idea that we have when we talk about data sharing, especially in contracts, is to ensure that the service provider's ability to use the data that is shared by the bank is only limited to offering the respective service that they are intending to offer to the bank. Any like derived data that could mean any data that is generated out of the data that the bank shares or any confidential information shared by the bank should ideally be the bank's property, and this could not even if the vendor does not come up with this derived data by itself and intentionally, even if it is a byproduct of the service that they are offering to the bank, ideally the bank should kind of make sure that it owns the data that is generated here. The agreement should accordingly have appropriate data protection clauses. Banks should have the rights and the inspection rights to kind of make sure that the measures that we are contractually imposing on these vendors are actually put in place by the vendors as well. Banks then must undertake a thorough impact analysis of the new banking models. For example, we've recently seen banking as a service through embedded platforms is a very popular model with a lot of banks that we work with. While exciting for the customers, the banks, being the regulated entities at the back end, need to make sure that they are aware of the risks that they face by kind of getting into these sorts of arrangement. Like I said, the audit rights and the monitoring rights that the banks have would be crucial in these particular instances where the banks should ideally have the ability and should practically use that ability to kind of check where they have partnered with third parties, that these third parties essentially are actually complying with the contract that they've signed with the bank. One more important thing is customer services. Like I said, there's a huge dependency from the customer side on the digital channels. Now, it's not just the front-facing user journey that can tank at any given point of time. There may be issues at the back end, which is why the customer's request is probably not getting processed in the manner that the customer wants to. This could lead to a lot of backlash, and in today's social media age, backlash doesn't really take a lot of time. Like anyone can go ahead on Twitter, Instagram, and kind of start writing negative feedback about any regulated entity that they are a customer for. So given that we live in this...
In fact, I mean, by way of a slightly humorous take, we had a client about whose CEO, the regulator picked up some untrue statements made in the media, actually reported in the news media. And when I say untrue statement, something to the effect that this gentleman was not well or is going to take it easy or something of that sort. And ironically, that was picked up by the regulator and therefore brought to the attention, and the company had to issue a clarification. So in today's day and age, word travels quickly. So the kind of chalta hai approach that permeated the market, say 5 years ago, or the we are a small company, we can't match up to a bank's expectations kind of approach that was there a few years ago. Good idea to kind of dial that down a bit, because if you are, the RBI is very, very clear, if you are doing business in this highly regulated space, you are expected to have all of these systems up and running.
Again, like I was saying, when the customers essentially have a seamless experience when they're using a tech platform, customers will also expect a 24/7 support service that the bank kind of offers. This can be through a chat messaging service that the bank has in place, or actual like employees that they have, or outsourced partners through whom they essentially offer these services to their customers. The banks ideally ought to continue to build and retain the trust of their customers by ensuring that there is transparency in how the customer data is handled as well. Usually, we've seen that whenever the regulator kind of comes up with any restriction or cracks down on any of the regulated entities, that is when any customer will feel kind of unsafe and like not trust the regulated entity. One recent example is that of a TPAP where, again, RBI had to come out on multiple instances to just clarify that while there is non-compliance, the RBI clarification ensured that there is no panic amongst the everyday customers. Anushka, if we can move on to the next slide. So in the last year, there have been a few updates in terms of the regulations by the RBI. The primary one, and if you've been watching our series on these banking webinars, we did a webinar on outsourcing of IT services and financial outsourcing. Primarily, again, how they deal with outsourcing is typically where in financial outsourcing, basically, RBI has an intention of providing a comprehensive policy for effective oversight, due diligence, and risk management of outsourcing activities that are carried out by banks or NBFCs. And they essentially intend to regulate the financial services that are outsourced by any regulated entity. And similarly, when I talk about the IT outsourcing directions, the idea is that whatever tech is being outsourced, if it is a material outsourcing that essentially a regulated entity is doing, then the idea is that the outsourced like entity essentially has to comply with certain obligations from these guidelines. Now, technically, these entities would not be subject to these guidelines because they're not governed by the RBI, because they're like fintechs or tech service providers. But the regulated entities would have to contractually flow down these obligations. How RBI has gone into defining material outsourcing is in this way. Like if an activity is disrupted or compromised, if it shall have the potential to significantly impact the regulated entity's business operations, or if an activity, if it is impacted, then it may have a material impact on the regulated entity's customers in the event of any unauthorized loss, theft, or like any unauthorized access of the customer information. So this is how essentially they've kind of defined material outsourcing. Primarily, and I'll delve into this in more detail when we talk about the contractual arrangements later on, but the arrangements that the bank has in place with these third parties should account for the termination, exit management rights, generally ensuring that there is certain level of business continuity and disaster recovery planning that is put in place by this third party. The supervision again flows directly from that, like the RBI and the bank has to have a right to kind of audit and inspect the measures that have been put in place by this third party. Additionally, we briefly touched upon the data security protocols. There have to be clauses in the agreement and they have to be practically checked during the audit and inspection rights, that there is enough segregation of the data, like the data sets of two, say, regulated entities is not mixed if a same service provider is offering multiple services to multiple regulated entities. There are certain exceptions.
So while this is easy to speak of and say and do, the rule against mingling of data is something that a lot of service providers that provide services to banks, technology services to banks, struggle with, because that's not how their core business usually is planned from day one. So if you're building a business that is going to primarily provide services and technology to banks, good idea to start from day one in building your product or your service up by kind of recognizing that each bank will want you to silo the information and data that you get of theirs. Now, a good follow-up question is, hey, then how do I run AI on that? Can I have lakes, data lakes, which, kind of mingle some of the data sometimes? And that we'll do in part 2 of this session. But a general rule is for simple products, try not to mingle data of different REs.
Apart from this, there has been a new draft master direction from the RBI on managing the risks and code of conducts in financial services. While largely similar, it kind of provides certain additional parameters for the bank to consider when they are essentially appointing a service provider for the due diligence, for their due diligence perspective. Additionally, in the contractual arrangements with the third parties, there has to be reference to certain SLAs, which we'll again address more in detail when we get to the contractual arrangements. One important point here is like they've factored in joint testing of the business continuity plan that the third party has in place. Ruchika, do you want to take up the information governance here?
Yeah, so the next a new regulation that the RBI came up with is the Master Directions on IT, Technology Governance, Risk Controls and Assurance Practices. So if you see at the fag end of the circular, it basically combines all the different circulars of the RBI launching from 1998 to 2017 with respect to VAPT, cybersecurity, cyber event, etc. It had like a proper definition of what constitutes a cyber event, what is cyber security, in what instances would regulated entities be required to report cyber security incidents and accordingly flow down obligations to its vendors. One very interesting thing that they accounted for is that whatever third-party vendors that are not accounted for in the IT outsourcing regulations, they said that while partnering with these things, REs have to ensure that appropriate risk assessment has to be done. While flow down obligations to a certain extent have to be included as it has been stated in the master directions of IT governance, but it's the ultimate responsibility of the RE to have certain risk parameters to ensure that there is a risk, eliminating any risk of data leakage, ensuring that there is availability of security. If there is VAPT testing has been done, there are reports being given, and accordingly, if the RBI requires the reports from the vendors, the bank will procure the same, and so on. So
Ruchika, if we can take a step back here. So what that means basically is that there are a set of entities for whom the RBI has prescribed clear cybersecurity, IT governance, risk controls, and assurance practices, right? And what that then means is that you have to create internal paper trail at the bank's end to show the RBI that in contracting with X or Y, or in adopting this technology, the bank has done some kind of an assessment of its impact on 8 to 10 parameters, right? And because of 1, 2, 3, 4, 5 reasons, the bank is of the view that going ahead does not pose a threat to governance risks, that the controls in place are good enough to kind of mitigate too many of the risks that may arise. These are in respect of specified technology outsourcing contracts. Even if you were to fall outside those technology outsourcing contract regimes, let's say you're a SaaS player providing, I don't know, HR management software to the bank would still have to conduct an assessment, which common sense would indicate should be approved by a board, which would then be in place for all other technology arrangements, which would then assess whether those arrangements pose a risk to the technology governance framework of the bank. Do they pose a risk to the cybersecurity and data protection imperatives that the RBI has placed on them? So there are banks who still don't have this as a regular part of their process. That is problematic. Yes, you're right. The RBI has not expressly come and said that you need to create this paper trail every time you adopt some technology, but we work with the RBI very regularly. We are sure that that assessment is what the RBI refers to as the spirit of these guidelines, right? You not taking those steps as a bank or a regulated entity is something that the RBI, we can give it in writing, will frown upon. As a service provider, not trying to comply or cooperate with the bank in their endeavors to kind of ensure technology governance at your end is also something that is going to invite censure, if not from the central bank, but from the bank as well, once the central bank, conducts its audit and gives its directions to the banks. So bottom line again, one, you need to do that assessment. Let's call it an impact assessment. And two, that needs to be on record and circulated internally within the bank. Maybe good practices would be to share it with the technology service provider, and good practices would be for the technology service providers to then communicate to the bank what controls and mitigation measures would be adopted. All of those need to be chalked out in writing in a traceable, auditable method, in our view, to satisfy the new rules.
So just adding on to what Mathew had just said, the regulations do prescribe a lot of mechanisms in which REs can ensure it. One such way is by contractually requiring the vendor to write a certificate that the application or the software that is being provided is free from any vulnerabilities. In fact, in case of critical applications, the bank has to obtain the source code of the application, and that has to be contractually captured as well. So these are certain nitty-gritties that the RBI is accounting for and requires the REs to impose on going forward with their agreements with vendors. Now, the next important circular that came in, which is which came in a few months ago as well, is the circular and streamlining of internal compliance monitoring. So basically, the RBI wanted the REs to have like an integrated tool to ensure that all compliances at the RE's end are at one level. There needs to be a dashboard to ensure that every compliance position of the RE as a whole can be viewed by the senior management as a whole. You need to have continuously monitoring operations of the RE to ensure that there is effective assessment and monitoring of any compliance requirements. If there is any identification of any non-compliance, that can be immediately mitigated, and escalation matrix needs to be also implemented. Also, there needs to be a effective communication between the business, IT, as well as the compliance teams to ensure that all of the relevant stakeholders that are there involved in ensuring that the requirements of the bank are complied with are in the same page when we are looking into any probable issue or cybersecurity incident that the bank might face. Now, the last recent notification that the RBI came up with, which is very particular, is with respect to the credit card and debit card issuance directions. It included our whoever issues a card to ensure that the outsourcing of financial services, the master directions that which came in April 2023, are applicable to them as well. So outsourcing is being looked at very carefully by the RBI, and they want that all the REs are compliant with it at every stage of their financial projects. We can move on to the next slide. Okay, the next slide is with respect to the recent RBI crackdown. So if you have been seeing itself today in the morning, there was a recent notification by the RBI that two major players in the financial ecosystem have been penalized for certain non-compliances. Now, in the past few months that the RBI, from public information that we have gathered, over 150 different types of banks, and these are not just commercial banks, these include small finance banks, these include urban cooperative banks, payment banks, all have been faced with multiple levels of penalties by the RBI. So the question remains as to what extent are the penalties imposed and why these penalties are being imposed at this stage. Now, if you see here, now we have categorized it into 8 different phases as to why the penalties are imposed. First is the non-compliance of the KYC and AML related compliances. These are particularly after the KYC master directions, which came in 2016, 2017, the RBI has been very particular with the fact that KYC needs to be implemented. Again, with respect to outsourcing regulations with the IT and financial outsourcing regulations and the IT governance framework, outsourcing regulations with not just the banks, but NBFCs has to be ensured. We have had reviews from our clients, which says that the contracts actually are being reviewed by the RBI thoroughly and are being vetted to ensure that appropriate flow down obligations are being enforced. Thirdly, reporting obligations. Reporting obligations is something which has been scattered across different regulations by the RBI, including outsourcing, including the information security incident, the certain regulations, etc. But any specific information security incident, be it a cyber security or a mere reporting obligation of your net worth, has to be complied with the regulated entity. Now, the fourth point is the data security. Now, in the recent few months, you must be aware that data security has the RBI has been looking at data security to a very large extent, with so many regulations and the DPDPA also coming into picture. The importance of personal data and financial data has never been much more the focus of by the RBI. In a few instances that we have seen is that often with the new digitization of banks and people being able to access mobile and use mobile applications of banks, we have seen that data security is often being neglected at this stage by various banking entities. Now, this and like there was lack of adequate data security measures that had to be undertaken by the bank. So in this stage, data security in itself is very important and needs to be continuously looked at and monitored by the bank. Now, if you see the next 4 instances in which the RBI has particularly cracked down is with respect to primarily how the bank in its internal operations work. Now, this is with respect to third-party risk management, business continuity, user access management, and change management. Now, if there is any access control policies or any access mechanism or authentication mechanisms that the bank has to implement. This needs to be done at not only at the user facing app or the customer facing app, it has to be done at every stage of which data is being transmitted. For example, in a BaaS integration that is happening with the fintech, a patch management policy cannot be just implemented at the bank's at the bank stage. It has to be contractually flowed down to the vendor to ensure that appropriate user access control mechanisms and access authentication controls are being implemented by the vendor itself. Similarly, with respect to third-party risk management and business continuity, these two are critical aspects that the RBI has been looking at. BCP and DR are extremely crucial when we are looking at any major financial institutions trying to upscale their business, right? If there is any downtime or if there is any discontinuity in the services being provided by a bank, it impacts not only the consumer, but the entire financial ecosystem can come at a halt. So business continuity and regular testing of the BCP and the DR drills, along with not just the bank, but the appropriate vendors who are hosting the banking application, is extremely critical. Third-party risk management is again something which has been talked about a lot, and we will speak as to how we can contractually structure this. But these are assessments that the bank needs to internally take before engaging in any particular vendor. Based on our
if I could just jump in,
yeah,
there's product council on this call, right? And product council building products for banks. What I would suggest is rather than building a tech solution and then selling it to the bank, if you could mentally place yourself as if you were building it within a bank, right? And divorce yourself from the bureaucratic approval processes that might be required to fund the project. But assume that you are building it within a bank that is then overseen very closely by the RBI. And so build it as if you're in a large organization that has all these risk considerations in play, right? Business continuity, third-party risk, user access management, change management, data security. And if you work yourself up from that base, your product will probably be much closer to a fit for the regulatory concerns than otherwise. Build the tech and then try and adapt it to the requirements that the RBI wants or that a bank wants is a much longer, slightly inefficient route, right? Build it with governance by default, right? Build that into your basics itself. But yeah, that's an approach which I think when we negotiate on behalf of banks with TSPs, it's very, very evident the ones who built it for a bank as if it's by a bank, and then the ones who've just got some technology which could be useful to a bank and you're kind of selling it to the bank. That's very evident to us lawyers. Imagine how evident it must be to the product people at the bank and the governance people at the bank.
yeah. So last but not the least, I would just want to further emphasize on the recent, based on the lessons that we can learn from the recent case studies that we have come across. There have been instances where customers' card details were being displayed on other person's application, or the entire application were forced to shut down by a letter of the RBI because there were not robust protocols being in place, or certain continued failure by a particular bank for its non-compliance with respect to, say, business continuity and change management. Important lessons can be learned as to how robust architecture of the bank needs to be developed, not only in the customer-facing application, but the core banking solution in itself. We'll move on to the next slide.
Yeah. So while there are actions that are taken by the RBI, it's not immediate. Like in our experience, whatever we have seen, RBI does not immediately resort to either imposing any fines or any restrictions. Before starting imposing any restriction on the bank or even imposing a fine, the RBI usually will issue some sort of a show cause notice to the regulated entity. It will give the RE a chance to kind of explain itself as to why there has been any non-compliance, if any. Once the regulated entity reverts to the RBI with an explanation as to why a penalty ought not to be imposed on it for any failure at its end, the RBI will evaluate this. It will give the regulated entities some kind of leeway, some time to kind of fix any defects that the regulated entity has, like at its in its tech infrastructure. If the RBI again decides that any explanation that is provided by this regulated entity is not satisfactory, RBI will then go ahead and impose certain restrictions. Now, these restrictions can be in multiple forms. They can either be through a monetary fine or a penalty, and this may very well, depending on the kind of defect or default that has happened at the regulated entities end, may range from, say, a few lakhs to, say, 100 crores, depending on the severity of the default at the bank's end. Apart from that, the RBI has also gone ahead and ordered some kind of restrictions on these regulated entities. In fact, in the recent past, we've seen that multiple banks have been prohibited from onboarding customers through their digital channels. A few banks have been prohibited from issuing, say, credit cards. Now, in all of these instances, the duration of the ban remains a key monitorable. We've seen this with a large private sector bank, where the RBI has even taken a year to kind of lift these restrictions, indicating that they have kind of done their due diligence at their end to ensure that the bank's kind of infrastructure is robust and in line with what the RBI expects. But it's also, we've seen this in practice, that RBI will not unreasonably delay any such ban or restriction that they've imposed on these regulated entities. If the RBI is satisfied that the regulated entity is in fact like compliant with whatever defects that they earlier found out, they will kind of revoke the ban. One major step that we've seen, and this is mostly with respect to NBFCs that we've come across, if after multiple notices that the RBI has sent, multiple penalties that the RBI has imposed, the regulated entity is in fact not still complying with the regulations and is not aligned with what the RBI's expectations are, RBI has in fact cancelled the license of a few NBFCs in our experience. Again, this was only where
there are examples of, well, not cancellation of licenses, but similarly punitive measures on banks as well. What we can tell you is that banks across the country are now getting more vigilant on this, because it's become a huge threat for the bank itself, right, and the bank's business. So expect a far more aggressive position from all banks.
Yeah. As a result of this, like either one of these three things, say a monetary fine or a penalty, any cease and desist order from the RBI, or any cancellation of the license, an outcome that we have typically observed in the market is devaluation of business and degradation of public image. We've seen in the recent past, when RBI has come out publicly and kind of imposed some sort of a fine or a ban on any regulated entity, we've seen the market shares reduced by almost half within a day. Banks have lost more than like 100,000 CRs in their market cap in one single day. And the cost of losing the public image is also very high. As a customer, if the bank that you essentially trust with is unable to comply with the primary regulators' requirements, as a customer, I feel it's very hard for any customer to then trust the bank, and then it will consequentially lead to loss of customers for the bank. We can move on to the next slide.
Yeah. So I think from the presentation so far, we have understood that risk management and governance structure of any regulated entity, and particularly banks in this instance, is extremely crucial. Now, how do we implement a robust governance structure in place, right? I think it begins at the very top of the banking industry. First, at a particular bank's level, we need to have a very robust governance structure, and it has to have a dedicated digital governance committee, which looks into the digital operations of the particular bank. With the increased digitization of the banks and offering multiple mobile apps, as well as partnership with fintechs and BaaS offerings and so on and so forth, a governance structure which actually talks about strategic decisions, and a IT steering committee, and a functionally operating committee which regularly speaks about the risks that the bank is foreseeing or has combated is extremely crucial, right? An IT steering committee and a strategy committee can sit together and understand what are the 5 different risks that the bank faces, and to see from market trends as to what are the emerging techs that can also be included in its overall operations. The second important thing is management of risk. Now, management of risk, RBI has in n number of occasions talked about how the risk management framework can actually be done. It requires banks and regulated entities to have a very robust risk management framework and a third-party risk management framework, which will deal with external risk, and a risk management framework which will deal with internal risks. Now, what could be a risk with a third party relationship? Let's take that example, right? It can be a risk that is arising from a cloud service provider, or it can be a reputational risk if you're partnering with an entity which is has been penalized by the RBI, or it can be cybersecurity risk, a legal risk, or like if there is a concentration risk. If you can see in the previous slides, we had talked about how there can be a dependency on one particular entity, and the application itself, the customer facing application, can go down. And this is one of the IT issues that the RBI has highlighted with one of the major commercial banks in the country, right? An increased dependency on only one particular vendor might have this issue being faced by multiple banks. So how are we going to tackle this, and how can banks develop a proactive risk management framework to this extent? Now, in the recent guidance note that the RBI has launched in back 1 month ago, they actually talked about and implementing an operational risk management framework. Now, as part of this risk management framework, they identified 3 lines of defenses. Now, these 3 lines of defenses are basically business unit management, an audit function, and an operational risk management. Now, what constitute a business unit management? Business unit management will basically be responsible for identifying and managing the risks that are there inherently in a business. If you're partnering with, for example, any entity, or if you're partnering with an unregulated entity, what are the appropriate security protocols, or establishing if there are adequate resources being deployed for the particular endeavor that you're going to undertake. These are certain critical aspects that every business unit management needs to look at before entering into any vendor agreement that you have. The second one would be the audit functionality. Now, audit functionality is something which is very critical when it comes to the line of defense when it comes to the banks. Now, what exactly the audit function would be would invariably be structured contractually, right? If you're partnering with a third-party vendor, you need to flow down appropriate audit obligations, which will be there, and we'll talk about that in the latter slides. But audit is one of the most critical aspects, which have not only been spoken about in the outsourcing regulations, but the IT governance structure as well. Additionally, needs to be an operational risk management framework. Now, what this risk management framework basically means, as they need to have an independent view of what the business unit management is undertaking. They need to have appropriate security protocols. They need to have an appropriate due diligence checklist, and understanding what the risk allocation of a particular vendor agreement would be. Designing an operational risk metrics when you are entering into an arrangement, and understanding whether this would have a high risk or a low risk, and what are the things that needs to be implemented from a security perspective. While understanding the risk management framework and strategies that the banks can implement, some of the few critical things that the banks should look at is first is access controls. If you're giving access to your servers, your premises to an unregulated entity or any vendor, appropriate obligations need to be put in place. Secondly is data security obligations. If data is being secured or is being transported to a third-party servers, is the data being purged? How long is the data being stored? What are the processes in place? Who are the processors? Is the data being migrated outside India? These are critical questions. While we are able to very conveniently overlook these things when we are talking about data security measures in place, but needs to be fundamentally understood and will depend upon a case-to-case basis.
So again, the RBI requirement is a analysis at the end of the bank on these issues. It does not necessarily prescribe end results or mitigation steps or risk management steps. What the RBI wants to make sure at this point is that each bank has thought this through properly, and there's paper trail to the extent of that thinking through.
Great. Then these are the key considerations. Now, based on our understanding while reviewing agreements and while speaking to multiple banks and unregulated entities in the course of these few years, we have understood that these are few things that are very critical and crucial when we are looking at any arrangement with a regulated entity, especially a bank. Now, with the new IT governance and the new IT outsourcing regulations kicking in, and after the COVID pandemic, the RBI has become cognizant of the virtual working environment and arrangement that are there. If there are essential personnels not being, like one classic example I could give from, which is stemming from the IT outsourcing regulations, is that if any personnel is being utilized for any critical services that the bank offers, there needs to be an on-premise deployment of these individuals, and there needs to be appropriate clauses built in the agreement. Secondly, operational resiliency. I think we have spoken a lot about how operational resiliency can be maintained. Operational resiliency is a buzzword that the RBI keeps on using in various circulars and various speeches that are there, but building a very harmonized operations of a bank which has dedicated structures for critical and shared applications is extremely crucial. The third being data breach. I think data, again, being customers' personal data, is extremely important, and how the bank will be able to tackle a potential data breach or an actual data breach is both the things that the RBI needs to look at, and the regulated entity and the bank needs to look at very carefully. What are the steps that are and the security protocols in place to mitigate any particular data breach? What are the reporting obligations? All of these are key considerations which need to be looked at. Fourth is mapping of internal interconnections and external dependencies. Now, this is a unique new phenomena that the RBI has come up with respect to its recent notification and circular on the harmonization of the risks that are there now in that are faced by the banks. Now, RBI wants the banks to look at how there can be, is also aware of how there's a lot of dependency on third-party vendors for not only basic things like movement of, say, cash from one ATM to the other ATM, but like major applications being deployed, customer-facing application securities are being provided, virus protection, data security, things like these, which have external and internal dependencies in place. Core banking solutions at this stage are being provided by external vendors and are not being built in-house. As Mathew mentioned, that there needs to be an appropriate due diligence and appropriate paperwork needs to be ensured that there is some thinking through and some thought process as to why a particular vendor was chosen and what is the interdependency on it. Has they passed on the risk allocation metrics that was being implemented by the bank? If they yes, then are these certain things which are taken into account in the contractual agreements? These are things that the RBI will look at eventually very, very carefully when auditing a bank for a non-compliance that they feel it has happened. Fifth is again change management. As change management, we have talked about it in our previous slides that the RBI has recently started looking at what constitutes change management. If there is a senior management, that senior management needs to always be cognizant of the fact that what are the very critical applications that are being taken through by different vendors, and if there needs to be a constant discussion between the teams to ensure that there is security protocols being implemented at every level. And the last is the lessons learned from the feedback mechanisms. Now, this feedback mechanism is stemming from the recent circular by the RBI. They want banks to be aware of the lessons that has been learned from exercise and past. As you might be aware that the RBI requires banks to undertake root cause analysis and VAPT testing. These are internal testing that the banks regularly does as a part of their obligations under different regulations. But as part of undertaking these obligations, they need to also be aware and build mechanisms to ensure that it does not happen in the future. Critical business infrastructure and applications that are there are not disrupted because of a minor change that could have been tackled if testing had been done regularly. So feedback mechanism is again very critical at this point.
Ruchika, if I could just step in. One of the things that we found that the RBI has done over the last few months is that it's reached out to multiple players within the system and they've asked them to assess whether at the CXO level and at the board level, there is enough tech knowledge and should we induct people into the board or into the CXO levels who have specialist knowledge in cybersecurity and technology issues. Again, indicative of how important this is. Again, indicative of what organizational structuring needs to take place to kind of deal with the new world.
I think we can move on to the next slide.
So when we talk about a compliance checklist, like these are broadly points that Ruchika covered when we talk about the internal aspects that the bank has to have in place, specifically with respect to technology and the mitigation of risks. In addition to that, when we talk about any responding of incidents or reporting any incidents, while the obligation to report to the regulator, of course, exists, two other aspects that we've seen which REs may not completely kind of follow to the T is containment. Like if you figure out that there has been a security incident, one is there should be an immediate action plan that is in place to ensure that the RE kind of does not let the incident affect a majority of the customers that it has in place. And in addition to that, once you figure out that there has been an incident, there has to be, like Ruchika mentioned, a root cause analysis where you essentially figure out why this incident happened, and there have to be corrective measures that are put in place to kind of ensure that this sort of incident does not happen again. When we essentially talk about a third-party risk management here, this is more with respect to the third-party vendors that the bank will appoint. The tech preparedness, the mitigation of risks, and the response to incidents is more of an internal checklist that the bank needs to have. But essentially, when a bank is appointing a third party, depending on the relationship that the bank has with the third party, certain aspects will have to be evaluated by the bank. Now, they could be briefly categorized as due diligence programs for monitoring and managing risks, any viable contingency plans that the bank has in place. A couple of more things that we feel that the bank should also evaluate is the cybersecurity compliance that the third party will have in place. In addition to that, ideally, if the service providers, employees as well, if they kind of execute some sort of an NDA with the service provider again, to kind of ensure that whatever confidentiality obligations that the bank imposes on the service provider, there's at least a similar sort of obligation that the service provider will impose on its employees, on its subcontractors, all of that. The BCP DRs that are in place at the service providers and have to essentially be at the same level that the bank has in place. And a few other things that a bank should evaluate is the past experience that the vendor has in this particular domain, the financial soundness, the business reputation, any potential litigations that could affect the bank, and general external factors such as any political unrest, any social unrest. These are general things that the bank should evaluate before entering into an arrangement with a third party. The monitoring and the supervision aspects and the flow down obligations, I'll just address them in the next slide. So when we talk about structuring agreements with third parties, essentially it will cover everything that the bank would have kind of internally put in place should it have undertaken this activity on its own. I'll start from the subcontractor risk management. Now, whenever any vendor appoints a subcontractor, for a bank, it's a risk because they essentially have partnered with this vendor because they feel that this vendor has the ability and the capacity to kind of undertake this particular service. But in most of the practical engagements that we see, vendors often like use subcontractors to kind of outsource some of their obligations as well. So one is the bank needs to make sure it is aware of who these subcontractors are. There needs to be a consent that is obtained from the bank by any vendor before subcontracting any of its obligations to a subcontractor. Lack of this transparency just generally leads to a lot of increase in risks for the banks. Then I'll move on to the termination and exit management rights. When we talk about termination and exit management, one, it should not be easy for any service provider to just walk away from an engagement with the bank because there is like some issue. There have to be measures that are put in place contractually because it's not just the bank that will get affected, it's the customers that essentially the bank services, those will get affected as well. So when we talk about exit management rights here, if a vendor is going to say walk away from a particular arrangement, or even if the bank decides to terminate a particular arrangement due to some non-compliance at the vendor's end, there needs to be a transition plan that is put in place. Like till the bank essentially finds another vendor who can act as a substitute for the existing vendor, there needs to be certain obligations that the vendor complies with before this transition happens. Essentially, the vendor should help the bank transition to a new service provider in this particular time period. Now, when we talk about supervision by the bank and the RBI, this essentially goes back to the same discussion about the audit and the inspection rights that we essentially talked about in the first part of the presentation. Now, in our experience, again, now I'll slightly talk about us representing the fintechs here. So when we represent fintechs, there's a lot of instances where we see these supervision clauses, which the RE kind of tells us during negotiations that they never exercise these rights, and the RBI has never, in fact, like audited any of their partners. Now, while practically the RBI may not do it, a good metric and a good governance from the fintech's perspective here and from the RE's perspective is to have measures in place expecting that this audit may happen. And the RE should actually kind of inspect and monitor the services that these fintechs are offering. This will actually ensure that these fintechs are also complying with the RBI's intent and spirit as well as the letter of the law. Additionally, with respect to confidentiality, data security, we like the REs usually expect the fintechs to comply with provisions of the IT Act, any specific RBI regulation that is there. We spoke about there being no commingling of data as well. In the event there is any security breach, if there is any leak of any information, the service provider needs to inform the bank immediately to ensure that any measures that the bank has to kind of like put in place are put in place, and then the bank essentially does not have to suffer any blatant loss, even in terms of customer data or general customers as well. In light of the recent news and increasing dependence on tech for banking operations, we feel that the banks ought to prioritize these cybersecurity efforts, scrutinize the data-related clauses in its agreements with third parties. We've usually seen that there is a lot of the banks are not usually up for kind of negotiating and like going to the T when we talk about fine-tuning the details of these clauses. We suspect that RBI's increased scrutiny will lead to increased investments in generally the technology and the outsourcing tech arrangements that the bank has in place. There needs to be a deeper focus and scrutiny of this from the bank side.
Yeah, but just one quick point. When any regulated entity tells you to accept these clauses and they will never enforce it, for me, that's immediately a red flag. Both, if we were advising the regulated entity, would be like, perhaps it's time to think about how internally to operationalize these requirements. And if we were to advise the fintech, TSP, FinServe, whatever you call it, then we would be worried about putting things on paper which aren't working in reality, which would then mean that, hey, we could get hauled over for not actually implementing systems for all of this at a later date. Now you could say, hey, that's over lawyering, but the fact is that that has played out multiple times in multiple different contexts when it comes to regulated entities with the RBI in the last 2 years. So it is wishful thinking to think that these are things that you can get away with just contractually agreeing to do things. You will have to operationalize, set it in place, figure out how this works. In fact, compliance ought to be at the very heart of how you design products in this space.
Absolutely. And like when we talk about BCPDR as well, one is the banks ought to ensure that there is enough due diligence that they've done when they evaluate the BCPDR practices that a vendor has in place. But not just that, the bank, while doing this, when they enter into the actual arrangement with the vendor where the vendor is providing the services, if there is any issue that the vendor faces, usually and ideally the BCP and DR practices that the vendor has in place should address it. But regardless, as a good measure, the bank should also access the substitutability of any third party that can also offer this service if it is like that critical to the bank's operations. any viable alternatives that the bank may have will play an important part here, because one, the vendor, even while facing some issues, will be expected to then help the bank transition to the alternate service provider that the bank has like in mind. That's one thing. Then when we go to application security, banks have to ensure that these third parties that they partner with have adequate security measures to protect the software or application that is being provided. This can be by kind of evaluating the kind of internal processes and policies that the vendor has in place. Alternatively, if it's a vendor that the bank has kind of worked with in the past, the bank has that comfort. A lot of times we've seen that the bank kind of then imposes its own internal policies, and a lot of vendors in our experience have accepted that as well. This kind of then ensures that any app or any software that is being provided to the bank has the necessary security measures in place that are required, like to be put in place by the bank from a regulatory perspective. Then when we talk about SLAs, now this usually in our experience, this is something that is negotiated last when we are negotiating agreements for either the fintechs or the banks. Now, this operationally is one of the most important clauses, I feel. Any app that you're using, if there is any downtime that any customer faces, again, like we discussed, it just leads to a bad experience for the customer. If this app at the back end is being operated by any outsourced partner that the bank has, the agreement needs to capture SLAs, which make sure that there is not just some response time, but also a resolution time, which is adhered to. Now, while the agreement will capture this as a right that the bank has and an obligation that the service provider has to adhere to these response and resolution times, practically speaking, these resolution times are something that even if the vendor is unable to comply with it, in most instances, the regulated entities will see the nature of the issue, the defect, the deficiency that is there, and then take a call if they want to essentially impose any penalty. This will also tie in with the service credits or any other aspect that we have put in place for like these particular vendors. Yeah, we can just move on.
We hope this has been useful. It's a little less interactive than our usual sessions, but then here the topic is a little drier than most of our usual topics. And on that note, Soumitra, Ruchika, unless you guys have something to add, thank you very much for popping by. We hope it's been useful, and we hope that if there's one takeaway from the session that you will have, you will think very closely about banking technology as a core part of products in the future. Thank you.